first rates. The Nifty holding up at that 17,183 prints. That's not looking all that bad. About a 0.5% kind of uptick is what we've started off the day with. Of course, it remains to be seen whether we hold on to these levels or not, given that FI net shorts still remain above 90%. So let's see how long this move actually sustains. Lots of stocks in focus. So let's start off with Hindustan Zinc after the dividend announcement coming in from them yesterday. A 26 rupees per share interim dividend, which now amounts to about 11,000 odd crore rupees. That's one stock which is in focus, target of 3% higher. Tata Motors, which is looking to up its commercial vehicle prices come April 1st by almost 1%. That's another stock which is in focus this morning. And then, of course, there's IOC as well, which has got the in-principle nod to carry out their pre-project activities for a 61,000 crore rupee project. A very tempered move coming in on IOC, however. Zydus Life has actually got, a US FDA okay for a very critical tablet. So that's another stock which is going to be in focus. And then Bandhan Bank, which has approved the sale of written-off portfolio of NPAs worth about 4,900 crore rupees to asset reconstruction companies. Bandhan Bank holding up 1.5% as we speak right now. There's another US FDA nod coming in for Aurobindo Pharma as well. So that's another stock which is in focus too this morning. Couple of other order wins for an Edgy Infra, for BL Kashyap, for a Tata Power as well. So these are a couple of stocks in focus. And then Devyani International, considering after that block deal yesterday, Temasek has sold almost 2.9% stake at a price point of 145 rupees per share. Franklin Templeton has been the buyer and has bought about 62 lakh shares as we understand. So that's another stock which is in focus. Now to the high flyers from yesterday. Let's see what big boy, excuse me, Reliance is up to and whether that continues to support the market or not. So after that 3% move yesterday, today as well, it's inching up almost to that 1% gain mark. There was Bajaj Finance, which was holding out well, Axis Bank, ICICI, IndusInd Bank. They were all supporters, as was L&T and HDFC Bank, along with Ultratech Cement. They were all holding out very smartly. Not such a great move on most of the banking counters, while cement is just about okay. Kunal, not bad a start. Of course, it's not as convincing whether the gains are going to stay put up until close or not.
I think it's a good start, Aisha. I would say 17,200 is a tough resistance, and I think it's bound to be that the speed and the pace would slow down significantly the moment we are closer to the 17,200 mark on the Nifty. But then I think the approach from large cap names, as you were pointing out, many large cap stocks, Ultratech Cement, Reliance Industries, Tata Motors, etc. These stocks are showing a good follow-through price action. So that itself is an indication that this momentum should continue. The trade which I would look to go for in the opening sense is Anant Raj Industries. My sense is that the stock has confirmed a classical breakout on the short term as well as on the medium term charts. So that's a stock which I'd look to buy.
Rudra, let's get in your take then. For a quick view first up on the levels on the index, given that we're sustaining around the 17,190 mark, making our way to 17,200, the support from the broader markets. And what's your first trade that you're punching in?
Yeah, Avan, for me, Nifty is definitely holding those levels of 17,120 on futures. We are way above that. And today, if we can close decisively above zones of around 17,250, that indicates to us that market has bottomed. Even if you see Dow Jones chart also, we have given that small sharp breakout, and that levels are 32,400. So for me, markets have right now made that bottom and we are headed up. More short covering will come, and look at Reliance and HDFC Bank, they are holding, which is a good sign. And if we see now more short covering, if we see fresh buying to continue, I am definitely positive on this market. And once we close above 17,350 on Nifty future, I will confirm and say that bottom is already done. 16,800 will hold strong. So let us wait for FET event today evening and see the outcome, and then take a fresh call tomorrow. And then let us see today whether do we hold above levels of 17,250 on Nifty future. So for me, stock for the day will be Tata Motor, and that was also one of my buy calls today. This stock is headed towards 455 to 460 zone. Positionally a great buy. and this will be the stock for the year 2023 for me. Also, Balrampur Chini looks very strong, good risk reward trade to buy at current levels. So keeping a stop loss of 355, I am buying Balrampur Chini for a target of 400, and Tata Motor is also a buy for a target of 455 to 460 initially. Keep a stop loss of 405 on Tata Motor. So Tata Motor and Balrampur Chini strong buys, market definitely positive, and it will hold.
And welcome to a brand new show of Market Makers. It's that juncture of the market where a lot of debating will be done on the impact of US banking crisis. Crisis is not the word, but it is really the confidence which in last 6 to 8 weeks has got hit. For India, first it was when we saw sell-off in Adani group of stocks, and now globally, what is happening to the financial system per se. So what does that mean for India? Are we in for a scary repeat of 2008? If not, why? And if the similarities have to be drawn, what are the similarities? Let's take that conversation forward with Nilesh Shah of Envision. Nilesh, fantastic to have you back. Thank you for joining us. They say history does not repeat itself, but it certainly rhymes. Having learned from the 2008 experience, everybody's worried about 2023 again. Is the tape being replayed?
Thank you, Nikunj, and it's always a pleasure to be here on ET Now with you. Yes, I agree in the sense that it's pretty much echoing the same kind of sentiment, the same kind of noises that we saw in 2008. We're hearing something similar. Just that I don't think it's going to be as drastic as 2008. I mean, 2008 was a terrible year where I remember that the headline indices itself probably corrected by 60% or so from the peak to the bottom. So I don't think it's going to be as bad as that. Okay, and I clearly believe that a lot of the signs, a lot of the kind of playbook is already evolved and it's already out there. So I don't think the impact is going to be as bad as that. But having said that, could we be in for some more extended period of consolidation? Quite possible. That's quite possible. We really don't know. I think the biggest uncertainty is still going to be about what US Fed does. What is the stance of US Fed on both liquidity and rates? And that's going to decide whether for the rest of the year we are going to have a risk on trade or not. I think that's the key variable. Otherwise, I think there's really nothing much else to worry about, especially from a point of view where the markets are today. I think from that context, I don't see there's too much reason to worry.
Nilesh, I distinctly remember the subprime crisis started in 2007. When it started, financial market watchers, they coined a term called decoupling. In 2008, they realized that it's a flat world and everything in a sense is joined at the hip. What are the chances that right now what appears like a storm in a teacup actually in hindsight will be much bigger than what it is right now?
Well, it could be a tad bigger because, whatever challenges that we have faced, especially what have come to the fore in the course of last maybe 3 to 4 weeks, both in the United States and in Europe, that's something which could pretty much catapult into something which is much bigger than what it is even today. But will it be like 2008? Very unlikely. I probably think it would be more like 2013, which was obviously not a great year. It was actually a terrible year, 2013, but was not as bad as 2008. So I probably think that 2023 could be more like 2013 and not like 2008. I think in 2008, you actually saw a huge, massive global sell-off, capitulation, and the damage was huge. I mean, we've never seen indices go off by 60%. I don't think we're going to see anything similar like that in 2023.
Okay. Now, post 2013, we saw a rally in mid and small cap stocks. Mid and small cap stocks have done rather poorly, if I say, the last 2 years.
Yes.
So, if you're of a 2013 kind of a scenario, could the reflation trade be there in some of the mid and small cap stocks?
Quite possible. And what you could see is that some of the mid and small caps could probably still gravitate a bit lower from where it is today, especially depending a lot on what the US Fed does in terms of interest rates, because that decides the risk on trade or not, whether we are in risk on or risk off. But assuming that they do correct a bit more from where we are today, I clearly believe that going forward from 2024 onwards, you're going to see a massive reflationary trade happening in mid and small caps. Valuations as it is have become reasonable with a bit of more correction, they become even more attractive. I think the pressures in terms of raw material prices, input prices, they have started to abate. We're seeing crude from $140 down to $70 a barrel. Interest rates probably have peaked, at least in India, they look like having peaked. The Reserve Bank of India has been saying that the inflationary pressures are behind us. In fact, there's a stability report of theirs where they've reaffirmed the growth for FY24. So I think fundamentally, we seem to have hit the bottom, fundamentally. If prices were to correct a bit more, especially on the mid and small caps because of global reasons, I think we're set for a very, very strong rally in 24. The other thing which there may not be a causal effect or a cause and effect relationship, but 1 year prior to the general election in India is typically not a great year. Rewind, 2019 was the election year and 2018 was not a great year. Rewind further, 2014 was the election year, 2013 was bad. 2009 was the general election, 2008 was bad. 2004 was the general election, 2003 was bad. Fast forward, 2024 is the election year, we are in 23. 23 for now at least is not looking all that great. Okay? So I think investors with a 1 year plus horizon and with the conviction in India's potential, I think will be hugely rewarded 2024 onwards.
So since election is something which nobody's talking about today, but I'm sure 6 months from now, everybody will talk about elections. And when you are moving into a new election cycle, 6 to 8 months before that, the curiosity, the nervousness, the commitment always goes down. So what are the chances that next 6-7 months, by the time global markets recover, Indian underperformance will continue because of the general election cycle?
I wouldn't rule it out. Though I don't believe that India will underperform. I probably think at worst case or a base case scenario, India will probably be in line with global markets or in line with emerging markets. But I don't think that India will underperform because things like financial stability, inflation, the macros of India are a lot better than where they were in 2013 or 2008. See, mind you, in 2013 and 2008, we had huge challenges of inflation. Today, at least, our inflation rates are not way higher than what it is the world over. If at all, it's actually been lower and managed reasonably well. Actually, hats off in the way our macros have really got managed. So kudos to the entire team out there from the government and policymakers side. So I don't think it's going to be worse than global markets. It probably could be that India would fall or correct or consolidate in line with global markets. And then after that, I think come the end of this year, the start of next year, 2024, you're going to see a huge outperformance coming in from India because again, all the positives will come back, the world gets into a risk-on trade, and India is going to be the dark horse.
Let's divide the market in three time phases: 1 year, 3 year, 3 year plus. What looks good and attractive for 1 year, 3 year, and 5 years?
I think because from a 1 year perspective, the large caps look good. Okay. I clearly believe the large cap. Buy the Nifty or buy a basket of maybe 5 to 6 stocks in the Nifty, and I think they all have come off on an average by about 25%, 20 to 30% from their peaks. Maybe the room for them to fall further could be 5 to 10% because you can never say where the bottom is. But I think from a 1 year perspective, I think that pack will do extremely well. Okay, so I think from a 1 year perspective, I think that's the space. From a 3 year plus perspective, I clearly believe that the mid caps and small caps will essentially are going to beat every asset class globally and in India hands down. So I clearly believe from a 3 year plus horizon, I think mid to small caps look really well poised for a big outperformance.
5 year plus?
Hard to say, but I think 5 year plus, I clearly believe that in a bull market or an upcycle, the mid and the small caps will outperform. And this has happened always. And so if you ask me from a 5 year plus, again, it's going to be largely mid and small caps, which will do extremely better. Now, you could, when I say mid and small caps, it could also mean a bunch of stocks which today are probably hated, are large enough, but you can't call them as mid and small caps because the capitalization is a bit higher. But for example, some of the stocks on the online side, which had IPO'd in 21, I think from 5 years from now, these could be hugely profitable companies and they could be a lot more valuable than where they are today. So it could be a set of stocks which are either hated today or are doing well but are still mid and small caps. So from a 5 year perspective, I think that's the pack which will do very well.
Okay, so I go back to the beginning of the question, 1 year. 5 to 6 large cap stocks. What would be the combination here?
It would be a combination of, say, for example, I think Reliance Industries, which we own in our PMS, I think Reliance Industries looks good at this kind of price. From 2,800, it's probably down to 2,200, but I think, I mean,
it's underperformed. Even at
it's-
2,800, it's
yes.
underperformed, I think, from last 2 years almost.
Yes,
now.
it's underperformed, but I think over the next 1 year plus, I think currently it's underperforming also because it's announced a capex plan, it's announced a borrowing plan, and the street tends to take all of these with slight bit of negativity or bit of caution. But I think it's there pretty much in the price. So I think that at this kind of prices looks good. I think the HDFC twins, I think they look good. Especially post the merger, I think they should look good. So that pack looks extremely good. You could even kind of say ICICI Bank or anything like that. I think some of the defense names like Bharat Dynamics or Bharat Electronics, some of these names which I'm taking, we own in our PMS. I think these kind of companies they look pretty good. I think from at least even a 1 year or even from a 1 to 3 year perspective, these kind of large cap names look good. Some of the names in the insurance side, names on the mutual fund and asset management company side. I mean, we own HDFC, AMC. I mean, yesterday it was trading at 25 times trailing earnings. 25 times trailing earnings for a business where the penetration is just about 2, 3, 4%. You're going to see more and more people and investors come in and participate in SIPs. And a business does not need capital. On a base case, this business has 10 to 15% likely earnings growth, or 25 to 30% return on equity. So highly capital efficient business, and a business which could keep growing for the next 5, 10, 15, 20 years and trading at 25 times trailing earnings. Okay. Probably the peak was at 50 times trailing earnings versus that is 25 times trailing earnings. I'm saying these kind of stocks look extremely good. They may not create fireworks for you, but would they be good place to be in from a 1 year plus perspective? I think so.
The anchoring for portfolio is also a function of the macro conditions. If interest rates are low, if commodity prices are low, these are perfect conditions to buy into small and mid-cap stocks at a bit of a beta. If inflation is high, if interest rates are higher than historical averages, it's time to buy defensives and where you can protect your money. What should be the anchoring of the portfolio?
See, my view is that at this point of time, it may not be the best place to go into defenses. When I say defensive, we're probably referring to FMCG kind of a pack, or maybe the core pharma pack. This is traditionally what we have called as defensive.
Maybe IT also.
It might be IT as well. But Nikunj, what I think is that maybe the macros in terms of worst, they have probably peaked out. You know, if at all going forward, I would probably think the probability of a rate cut is way higher than a rate hike. Okay, so to that extent, I honestly don't think this is a great time to be yet in consumer place. You may probably be there 1 or 2 names which you like, but I don't think FMCG is the place to be in. And purely simply reason because their growth from a volume growth will at best be 5 to 8%. Today, I would really kind of struggle to say that can a FMCG business grow in volume terms at 10% plus? Very unlikely.
They're growing actually lower than the GDP,
So-
to put it very simply.
Yes. So in the consumer pack, I think outside of FMCG, maybe things like alcoholic beverages, which we have been now liking for a long time.
But why were numbers for United Spirits so bad? If there's so much of commanding market share, the big picture that, you know, good or bad
Yes.
times, you will always consume alcohol.
So first is, I think, the industry-related challenges, twofold. One is clearly input prices. There's still kind of challenges there in terms of input prices. Cost of freight, cost of packaging, cost of bottles, cost of raw materials, all of that. Second is in some of the states have not yet given them price hikes. So these are 2 industry-related challenges. For United Spirits, which is a stock we own, they have challenges in terms of trying to reorient their portfolio, and they're trying to yet rejig. So that's still work in progress. But I believe that they have kind of traveled a large part of that work in progress journey. And it's quite possible that maybe a couple of quarters later, you start to see the impact of that positively. The company in that space that we like even more is Radico Khaitan.
For almost a year now?
We've owned Radico Khaitan now for almost 3 years.
3 years now.
And it's been honestly so far a great journey with Radico. And we still think it's still early days for the entire industry and for a player like Radico Khaitan, which is a challenger to the 2 big giants in the space.
How come you didn't buy Sula? Only a whiskey, beer, not dwelling on wine?
Nikunj, we are looking at it. It's IPO'd very recently. We are still kind of looking at it. We'll probably kind of spend a lot more time, take a more harder look, and then take a call. But the space is interesting. And therefore, Sula also falls on our radar. But we haven't yet taken a decision. I guess we're still very early in our research process as far as Sula Wines goes.
I have to ask you IT before I get into specifics of your portfolio. It's a season of change in IT. Macro changes, layoffs by big tech, and if that was not enough, change of top guard. Infosys has lost talent. TCS, Rajesh's exit.
Yes.
I read that Mr. Desai from Mastech has decided to pursue different roles in the company.
Yes.
What do you want to start with? Macro, layoffs, or change of guard?
I think Nikun, the macros and the layoffs affects them a lot less. These are pretty much steady state, like the way we alluded to FMCG companies growing in mid to high single digits. I think the large cap IT companies will still kind of have that kind of growth.
8-10% growth is here.
8-10%. I mean, if I were to kind of just, and I'm taking Infosys as a reference point, even in the best year, which was financial year 21-22 for the sector, their earnings growth was only 16%. In your best year, you're going to grow 16%. Okay, so I think we have to keep that in mind, that they will probably just grow in a range of about 10 to 12%, depending upon how your operating parameters are. So I would still think that, and the large caps have played out. We've seen a huge rebound. So if we look at it probably sometime later, last year in 22, or the start of this calendar year, the IT stocks were on the lower side. I think we've seen some kind of a rebound trade. I think we're done with that. I don't think from here they can outperform in any significant manner, the large cap kind of pack. I think in IT, I still believe that the change and the delta, and therefore the alpha, will come in from the tier 2, tier 3 names, the mid to small cap names. There they have very interesting opportunities. Somebody's getting into a new niche, somebody's getting into a new geography, there are client wins, a new CEO, new leadership team.
What do you like?
These are the kind, well, we own only 2 stocks currently. We own in fact only one stock which is called LTTS right now. And that's about it.
You've sold Tata Elxsi completely?
Yeah, we are out of Tata Elxsi. Okay. So we're going to be evaluating. I think we're going to take 1 or 2 more quarters. And I think in that environment, we will come up with extremely good ideas. But see a name like Tech Mahindra, which is large cap.
Change of guard there. Yeah.
But I think there's a change of guard. Somebody with strong credentials is really coming in out there. It's got the pedigree of the M&M group. The group CEO of M&M has been very aspirational and is really driving individual operating companies really hard. There is a change in leadership for Tech Mahindra. Size is great. They have very minimal exposure to BFSI. They are in communications and telecom and all of that. So that's one company where we haven't invested yet. But I think we would want to be watchful. We would want to see what the new CEO has in store in terms of his aspiration, his strategy, and all of that. We will see and we'll evaluate and maybe take a call there. So that's like one of the names which is part of our prospect list, but is not yet in the portfolio.
But this is the lowest positioning in IT in your portfolio as a weightage?
Yes, absolutely.
You're supposed to be the IT guy.
Yeah, but I think
anything in IT, go and ask Nilesh.
I think in Nikunj in 21 and some bit of early 22, I think we had a lot of excesses in IT. Okay, I mean, look at the excesses that we saw in names like Tata Elxsi and Persistent.
60 times, 70 times.
I mean, all of that. Okay, and so I think the markets had priced in as if the margins that they were reporting and the growth rates that they were reporting will continue for very extended periods of time. I don't think so, because our IT companies are services companies. These are not product companies. Again, within technology, maybe some of the SaaS companies, we don't own any of the SaaS companies yet, but I think some of them also might look very, very interesting. Some of them have come off by 60% already, 50, 60, 70% there's been a shave off. Maybe some of them become very, very interesting.
Nilesh, if someone bought, I was too young that time, but the old timers tell me that in 1990s, if you bought consumers, Nestle, Colgate, HUL, you pretty much got the theme right for next 20 years.
Yes.
If somebody is buying a Zomato or a Paytm or a Policy Bazaar, are these the high growth companies of the next 1 decade?
Undoubtedly, yes. I think these are essentially what we used to in 21 call hyperscalers globally. I think these are going to be hyperscalers of India. Okay. We probably just own 1 or 2 of the names that you've taken.
You own Policy Bazaar. You've gone
we've owned Policy Bazaar. It's amongst our top holding, and we've been constructive on it because we've clearly seen people are talking about part 2 profitability and all of that. But I think here there's a very established part 2 revenues because of the repeat premiums that get paid by policy holders. So yes, but clearly I think these are businesses which are addressing a huge opportunity, a humongous opportunity. And things like consumer demographics, digitalization, online technology, all of them, I think are powerful tailwinds which each one of these businesses enjoy. And I think wherever you can clearly understand the business model and see how things are going to unfold in the next 3 years, 5 years, 10 years, and you see a path to revenues, path to profitability, I think that's the time to really act on them. So I clearly believe that investors would make a serious mistake by not looking at them and taking their eyes off them. I think one should be constructive on them, because the winners, people who bought like what you told in the 90s, the HULs and the Nestles and all of that, took a view how these businesses will shape up in the next 5, 10, 15, 20 years, not about how the next 1 quarter or the next 1 year is going to be. I think we will have to look at these kind of businesses from a similar lens. So if there's one area which I think in the next 5, 10, 15, 20 years which can do really well, are some of these companies which listed themselves in 21 and are essentially consumer companies using technology to basically penetrate and grow their businesses.
And their market caps already, and purely forget the path to profitability, the market caps, the starting point. For Zomato, I think it's $6-7 billion.
Yes.
For Policy Bazaar, it would be
currently about $3 billion.
$3 billion.
Around $3 billion.
Paytm would be nearing $6-7 billion, maybe more actually.
Yes.
I'm not looked at the last number.
Yes.
But my point is that if the starting point is today, then you're buying these companies not at the valuation, not at the market cap of small cap. You're buying them pretty much as mature mid cap companies. So they cannot be multi-baggers. They can be compounders.
Yeah, they can be compounders. But over 10, 20 years, if something compounds in high double digits, you could call them as multi-baggers, which means that if a business, for example, or a stock delivers you a 20 to 25% annualized return over a 10-year time frame, they end up becoming 5 to 10 baggers over a 10-year time frame.
I'll just give this maths to our viewers. HDFC Bank has multiplied at 20% for 20 years. In 10 years, they become 10x, but they've compounded for another 10 years. At 20%, that makes it 100x in 20 years. Now, that's the math which is called as power of compounding. So if I have to put a lesson in this edition with Nilesh, power of compounding is the most important aspect which you really need to look at when you are starting your investment journey. Nilesh, now let's look at Policy Bazaar. He was part of a show called Class of 21. And he's gone on record to say that, look, I'm aiming at a profit of 1,000 crore by 2027. Official public information. Which means if I look at the current market price divided by the guidance what the management has given, we are looking at a stock trading at about 40-50 times, about 50 times FY27. So growth is great, but the markets are making the stock trade at 50 times FY27. So where is the margin of safety for you?
I think Policy Bazaar, if you really look at it today, the market cap would be, I think, about 25 to 30,000 crores. Okay. So if I were to look at FY27 and the guidance which the company has dished out of 1,000 crores PAT, it's trading at 25, 27 times FY27 kind of earnings. Now there are two things. One is that the end of the journey? Answer is no. I clearly believe that that's probably only the first milestone which a company like that has in a marathon which could last for several decades. So my view is that could just be the start, number one. Number two is, my view is 1,000 crore PAT in FY27 is to me a base case scenario. I probably think that they might achieve that maybe even a year earlier, or they could exceed the 1,000 crore number by FY27 too. Third is, in this market cap, they have about 5,000 crores of cash. Okay. So if you kind of look at it from an enterprise value perspective, strip off the cash, then it's even more attractive.
Yes.
And my view is that
they may start giving dividends. They may start
doing dividends, buybacks, all of that. They have clearly stated that they are not the ones who will go out and buy businesses so far. They prefer to build business rather than buy business, and I like that as an attribute. I see that as a virtue of a management quality, that you're willing to build a business. In addition to that, we always look at PB FinTech from just an insurance point of view, which is rightly so. Majority of the value today comes from insurance. But there is the credit business. I mean, that's a 100 lakh crore market. Okay, which they can probably try and address. In addition to that, they have got in principle approvals to start the account aggregator business. That itself, according to me, is a game changer in India's journey of financialization. They have got approval for being a payment license or a payment aggregator. So they have a few optionalities of which today we don't know. Today, it's just looked upon as an insurance company.
Distributor, actually.
A distributor of insurance. Then you have the distributor of credit. And then you have these 2-3 optionalities on which we may get a better color only sometime in the later part of this decade, which can be the growth drivers probably for the next decade.
So you're buying Policy Bazaar not because it's BFSI space, but it is a play on tech and growth.
Yeah, I mean, first of all, it's a play on demographics. I think
It's
Indians
a
are going
consumer
to,
bet.
absolutely.
It is not IT or it is not a bet on BFSI space.
Absolutely. I mean, I think the mistake which most of us, including myself in the 90s, made was to look at HDFC Bank as one more bank.
It was an FMCG company.
It was actually a consumer company. It was targeting salaried people. It was targeting savings account. It was targeting credit cards. It was targeting ATMs. It was using technology to essentially gain market share.
So don't buy it from the prism of that typical price to book, and that's the mistake one should not do with some consumer tech.
Absolutely.
Okay, I'll wrap it up with one final question. And you've owned HDFC AMC for a while. I think it's been a holding which is pre-COVID.
Yes, that's right. Maybe 3 to 4 years.
Okay.
Yes.
The mechanics of the AMC industry are changing.
Yes.
The commission structure is down. There is a case which the regulator has already made that the commission structure they need to go down. This is a competitive business. A PMS like you is challenging the incumbents here. More and more AMCs are coming. While the size of the pot is large, it's the fact that the TER and the margins are coming down.
Yes.
And if margins they go down further, it's a challenge for the industry. Why would you like to buy a business where growth is there, but profitability is getting compromised because of regulation and other factors?
Nikunj, I believe a lot of these concerns are in the price.
25 times?
I think 25 times trailing earnings for a business which does not require capital, which throws cash flows on a base case which delivers you 25% ROE, and for a franchise like HDFC. Okay, I clearly believe that at 25 times trailing earnings, a lot of these concerns, a lot of these apprehensions are in the price. My view is that yes, when the news comes out in terms of a lower TER and all of that, you might see one more knee-jerk reaction. But I think after that, I clearly believe for the medium term, there are no more negatives. You could only be in for maybe some kind of positive surprises.
So Nilesh, we've started with global micro and we're ending with a view on AMC. Tell us your view about life in general. Now that you're back at office, COVID, the worst is behind us. Your son is studying abroad. He's finished his graduation.
Yes, he's finished. He's finished.
So अब तो life में responsibility नहीं है, right?
Yeah, in a way, yes. In the sense from a work-life point of view, yes. I think one is back in terms of the balance. I'm glad we are back to the normal times. One gets to now travel for work, travel for vacations, all of that. So I think, yeah, it's one couldn't ask for more.
So what is the tip, not a stock market tip, but a tip of life from Nilesh? You've been reading a lot, so let me ask the philosophical side now.
I think to me the only thing is that your work should be your passion and your passion should be work. I clearly think that's the only way to enjoy. I think if you get this, then the concept of work-life balance doesn't exist, according to me.
Nilesh, we've been friends for 2 decades now, and my condolences. You've lost your mother. I had a fortune of interacting with her. So my condolences. A loss of parent, what I've suffered is something very tragic. But that is life. So my sincere condolences once again.
Thank you.
Thank you, Nilesh. Thank you for your time and hope to see you once again.
Thanks.
That's it on this edition of Market Makers. Thank you for joining us.
Back with first trades, just let's revisit the markets, and so far so okay as we're holding out by 1/3% for the frontline indices. Mind you, the small cap index is really flexing its muscles. It's a nice gain of about 1% or so, and you're really garnering support from all quarters, be it the PSU banks or the metals, for instance. IT too is packing in a punch, and barring PSE as a sector, all sectoral indices are in the green. So let's check in on the smart movers. Bajaj Finance at the top of the heap. Tata Consumer is doing well, nearly 2%, L&T, M&M, as well as Tata Motors. But let's move right on then and take stock of how things are shaping up at South Indian Bank. Nikunj in conversation with the top brass. Nikunj.
It gives me great pleasure to bring on board Mr. Mulli Ramakrishnan, Managing Director of South Indian Bank. Mr. Ramakrishnan, good morning. Thank you for joining us. It's your first time, at least on ET Now, on the morning show, so a warm welcome. South Indian Bank is revamping its business model. They're trying to reboot and regain their old mojo. Walk us through how things have changed for South Indian Bank post-September 2020, ever since when you took over.
I would put the changes into three broad areas. One on the structure of the bank. The way we were structured earlier was very different from the way we went about restructuring the bank. Today, if you ask me how we have done on the liability side, is that we have got a branch structure, and branches have a cluster structure between branch and regional heads, and there is we have 18 regions across the country covering about 927 branches. So there is a very clear line of authority in terms of a branch headed by a branch manager, reporting to a cluster, and cluster head reporting to a regional head, and regional head reporting to head of branch banking, which actually brought in a lot of sharp focus on the way we carry out liability business and all those businesses which were carried out from the branch distribution network. On the asset side, like the way we have, like the way many of the large retail banks have structured themselves, we have also brought in a vertical structure for all the retail, all the asset sides. So we have a today dedicated corporate banking group, dedicated SME group, dedicated agri group. In retail, we have home loan and LAP as a separate line of business. We have credit card, personal loan, auto. All these have been brought in like a vertical structure, which again has brought in tremendous focus on how we need to grow these businesses. So this is on the structure side. Second, I would say is a huge focus on quality underwriting and quality of sourcing. One of the things which actually plagued the bank in the past was the huge NPA levels and the huge hit on the provisioning which the bank had to take in order to manage the portfolio. So the only way we could have resurrected the situation is to completely focus on quality sourcing and quality underwriting. So we have done a lot of changes, initiatives in the area of sourcing as well as in underwriting. Just to name a couple of them, we have brought in credit models for underwriting retail products like personal loan, home loan, etc. Similarly, in MSME, we have brought in credit model built for a small end of MSME where the ticket size are generally up to 2 crores. And similarly, in the corporate side, we are focused on really good quality corporates with a rating of A and above. And I'm happy to say that almost 95% of the new acquisition which we have done in the corporate or towards the corporates which have been rated A and above. So across every area, I mean, we have brought in a lot of focus on learning and development. We have brought in a lot of focus on analytics. These are some of the new divisions which were formed in the last 18 months and which has brought in tremendous focus on various areas which we wanted to grow.
Okay. Where do you see your book size moving in next 3 years?
Currently, we are at about 70,000 crores as of Q3. And given the fact that the market is a little sluggish in terms of advances growth post-October, we would probably end the year with a growth about 10 to 12%, 12 to 13% kind of growth from last year numbers. So we are targeting about 72,000 crores by this March end. Next year, the plan is to take it to 83 to 85,000 crores kind of book size, and subsequent year we would want to target 1 lakh crore of assets. See, originally we came up with a strategy plan where we wanted to reach 1 lakh crores by March 24, but due to 2 years of COVID and the various changes which we had to do, we have pushed the entire plan by 1 year. So we are expecting 1 lakh crore asset size to be reached by March 25. But the plan which I have is on any day, I would focus on quality over growth. So if it means that we are getting good quality assets for growing the book in the way I'm saying, we will probably focus on that. Otherwise, we'll obviously give priority to grow quality over growth.
Would you be focusing on the retail side or the wholesale side to build your book?
We are actually fairly well poised in all the areas. So today, even if I look at the composition of my book, it's equally poised between wholesale, MSME and retail. So the focus is to grow continuously on retail, MSME in order to diversify the risk and to really cash in on the opportunities which are arising in the corporate and the wholesale banking side. So the focus will be to grow quality assets irrespective of whichever business line it comes from. Obviously, to overall manage the risk, we would probably diversify the risk through growth through quality, growth through MSME and retail.
Your CASA ratios have gone up, that's commendable, from about 25% to about 30% plus. 28 has become 34 as per the December data. Do you see this kind of growth sustaining?
Actually, CASA growth has been pretty good for us in the past, I would say 1.5 years or so. We have consistently grown from, as you said, from 25% level to 33, 34% kind of level. But what we are seeing now is a little sluggish growth in the CASA side, primarily due to the fact that today deposit holders and as well as investors have opportunities to keep their money in the other areas where they will be able to earn a little higher income. So we are actually finding the trend of many of the people who hold CASA shifting their funds into creating deposits. So we are seeing growth in the deposit side. To that extent, CASA has not been showing growth as it used to show. But we are fairly confident that we'll be able to sustain this level for a quarter or two, and then we will definitely aim to grow because we are seeing a lot of traction happening in all the four engines of CASA growth, whether it's NR or whether it's government banking or task as well as retail. There are a lot of new initiatives which we have taken, which we are hoping that when liquidity eases a bit, we'll be able to see growth coming back into CASA. Our target is to reach 35% kind of CASA level by next March 24.
Without raising capital, do you think you will be able to build a strong liability franchise that you don't need capital to double your balance sheet in 3 years?
Currently, we are having a very close watch on our capital adequacy. I mean, I'm happy to say that our capital adequacy used to be at sub 13% level. We have brought it up to 16.25% level. This has happened primarily due to two reasons. One is we went about raising capital of 240 crores in March 21 by bringing in good quality institutional investors. At the same time, we have churned our portfolio for a better quality, which has resulted in capital adequacy going up to 16.25%. This year, without taking into account this year's profitability, this is the first, I would say, normal year for us because we were doing a lot of changes and restructuring over the last couple of years. This is the first normal year where we are seeing consistent growth in our profits, and with the internal accruals happening quarter after quarter, we are hoping that our capital adequacy will be reasonably good by March. We will again take a stock in April and to see, depending on the growth plans which we have for the coming year, we will see whether we need to raise capital and in what form and in how much, etc. That will be decided in consultation with the board.
How will you ensure that the NPA challenges which had hit you in the last cycle, they are not repeated again? Because in India, sir, it's very easy to grow. We are a capital starved country. You can do lending very easily. You can build a liability franchise because you are a old South Indian bank. It's very easy to create a liability franchise. But the problem is when you start lending, how will you differentiate yourself in terms of the previous NPA problems which had hit the bank?
Yeah, I think the important thing is what hit the bank in the past is something which we need to learn from, and obviously we shouldn't be repeating such mistakes again. I think if you ask me, the key issues were in terms of quality of sourcing, quality sourcing, and in terms of quality underwriting. Earlier, the model was that a branch was the point where all the business were done. So clearly, you had the same set of individuals handling corporate case or a retail case or SME case. So there wasn't any, I would say, for lack of better word, expertise in these specific nuances of these businesses. As you know, all these businesses have certain specific nuances. So we need people who are who think through this all through the day and who are actually focusing on customers who belong to this segment. The understanding of such customers, understanding of the business model is very crucial. That is on one side. So with the way we have structured our bank now, both in the asset side and liability side, we believe that we are able to bring in that sharper focus on each of this business line. Today, I'm happy to say that each of our vertical resources are fairly well versed with the nuances of this business. I mean, we have a very young workforce. Our average age is 32. So you know that people of that age group are easily adaptable. They can learn many things. And so they are able to now clearly differentiate a good quality deal from a not so good quality deal. That's on one side. Second side, we have actually brought in a lot of science into the way we underwrite. I mean, having had experience in managing SME, retail and corporate book in my earlier stint in ICICI Bank, we have brought in a lot of such modern practices into this bank. We are using extensively analytics today, and we have built in credit models. We have completely digitized some of these businesses. So today, more than ever, you have a lot of secondary data available. You can use a bureau data, you can use a CMR, you can build credit model, you can do predictive analytics. We are using analytics extensively in the asset side, liability side, in collection side. So with all this, I believe that today the team is fairly well versed and are clearly aware of what is to be done. And the message that quality has to be the primary focus has been has reached the last person in the bank today. I mean, this is one of the things which I did very, very consciously, because unless we bring the entire bank into on board on this, it's not easy to maintain a quality of the portfolio. So in every communication which I've been doing consistently, at least once a month to the entire bank, I brought in this focus of quality. And today I'm happy to say that even when I travel to far-flung branches, you can see the branch resources talking the same language which I used to communicate to them. So I believe that it's a cultural change which has happened, and given this cultural change, it's not natural. I mean, it's not very easy for somebody to go back and do the old way of doing things. So I believe that we will be able to sustain this, and of course, thanks to economy, if it continues to do reasonably well, we believe that we'll be able to pick and choose the right kind of cases which should be onboarded into our book. So, of course, it's a continuous game, and there is no, we cannot let our control loose on the monitoring. We need to be looking at the pre-delinquency measures. We need to look at monitoring on a continuous basis. So, a lot of efforts have been put in terms of managing the portfolio, etc. So,
all right, Mr. Ambaksh, appreciate your time. So glad you could join us, and it was really a pleasure to have you on the show.
Thank you so much. Thanks for the opportunity. Thank you so much.
Okay, we'll pick it up from there then. Let's quickly take status check of what the market has settled in at. While we started off with about a 0.5% gain, we've slipped a fair bit from there, but we're still clinging on to that 17,150 level. Holding out still for financials as well as banks, it's oil and gas, power and media, which are sectorally under pressure right now. Within the Nifty, it's HDFC Bank also, which is lower, along with HDFC, Axis, Kotak. So some of these private banks are the ones which are weighing heavy on the indexes, as is BPCL, Cipla, NTPC, etc. as well. But still holding out for Bajaj Finance, Finserv, Hindalco, IndusInd Bank, HDFC Life, as well as L&T and M&M. But let's now welcome on board B. Thiagarajan, the MD at Blue Star, joining in on the show right now. A lot of different things to talk about with them. Mr. Thiagarajan, great to have you today on ET Now. Thank you so much for taking the time out.
Good morning. It's a pleasure interacting with you.
Thank you. Let's first talk about, Mr. Thiagarajan, the order win and the foray into railway electrification, because the order marks not just your foray, but wanted to understand what really is the strategy behind this. What is the time period for completing this order? Is it a long gestation one?
You're aware the construction cycle is on. Therefore, the electromechanical projects business segment of ours has been doing extremely well over the past 6 quarters. We are sitting at a huge record level order book. The company has around rupees 5,000 crores of order book. Now, there are various segments here. The most important one being the manufacturing sector, which is into capex cycle. Then you have got the infrastructure. Then you have got buildings and also data centers. Now, within infrastructure, the investments are taking place in metro railway electrification, substations, as well as water MEP projects. Now, so far, we have been a leader in metro railway segment, and we have been doing extremely well in data center as well as manufacturing. And buildings, we have been there for many, many years. The strategy behind diversifying into multiple verticals is to de-risk ourselves, because the construction cycle will go through many challenges. Something will come up in 1 year, another year some other segment will take off. So we wanted to be present across all the segments. The railway electrification is one area in which we have not been present. And we understood with the Government of India's intention to go ahead and invest in the rest of the railway electrification that they have to do, and also speed up the lines. There is a speed enhancement program that is also taking place. We understood that the potential for railway electrification is something like rupees 40,000 crores over a 5-year period. Therefore, we decided to enter this segment this financial year. We have won 4 orders totaling around 575 crores. And you are aware in metro railway, we are sitting on a huge order book. It is close to around 1,000 crore worth of orders we have from Bangalore Metro as well as Mumbai Metro. So you asked about how long it will take to execute. Typically, it takes around 18 to 24 months for the jobs to get completed.
Sure. So, over the last couple of quarters, Mr. Tyagarajan, one has seen that there has been an increase in contribution from the EMPs segment. Wanted to understand how are the margins in this particular segment, and can we hope that you maintain that 6.5% range?
It's most certainly. We have been indicating that the outlook is 6 to 6.5% for segment one. And that has improved over the years. If you see quarter on quarter, actually we are enjoying that scale benefit as well.
Okay, I just wanted to understand whether or not you're looking at any more such orders. Are there any inquiries that you're getting?
From railway electrification, yes, and water MEP projects, yes, and metro railway, quite a few places are taking place, and you will see airports, quite a few are going to get finalized. My sense is that apart from healthcare data center, we are beginning to see hotels also will see some kind of growth, and I think the next 2 3 years many hotels will have to be built.
Tyagarajan, let's also discuss the summer demand. There's been the heat wave, unseasonal rains. Do you think that that will play spoil sport when it comes to the AC demand this time around? And can you just walk us through so far for summer what the demand situation has been like?
It is excellent. Of course, I had mentioned quite a few times the summer rains are very common. Climate change is a reality, but all the forecast says that it will be a harsh summer. And the most importantly, the penetration levels are low, and therefore I expect the market during the summer season to grow at least to 25%. Now I'm going by the customer profile. 95% are first-time buyers. 65% of the market is tier 3, 4, 5. More than 45% of the buyers are availing consumer finance scheme. So therefore, you can imagine it's the aspirational middle class which is driving the growth. And you have seen again all the 5 quarters so far we have done extremely well. We look forward to close March on a high note, and the dealers are beginning to stock. And as far as Blue Star is concerned, we were, if you recollect, till 3 years ago, we were only in the premium segment. We introduced affordable premium in 2020. Now we are also in the affordable range. This is in order to improve our market share to 15%, as we have stated by FY25. So the demand is extremely good. There will be hiccups here and there. There will be rain, and there will be shortage of some models here and there. But overall, everything is well set for a great summer season.
You to equate that market share gain into growth numbers. What are you anticipating on a year-on-year basis from the current upcoming summer season?
So the market, I think, has reached around 8 lakh numbers. 8 million, and we are somewhere around 8 lakh numbers to 9 lakh numbers we will do. Next year, it will be a landmark year for the industry. I think the industry will cross 1 million market size, and we are aiming to do around 10 million market size, and we will do around 1 million.
We are getting some reports, Mr. Tyagarajan, and perhaps you are best, in the best position to answer that maybe consumers are now down trading and getting a little conscious of their spends. Is that something that you're as well seeing?
I have been saying this for the past 1 year. The demand is for affordable range of products. And in any category, I think that if one will have to grow their market share, you have to focus on the bottom of the pyramid. So that's where the growth is going to come from. That's so even in B2B part of the business, like let's say deep freezers. The demand is for 250 liter, 300 liter. It's not some 400 liter, 500 liter. Basically, when it moves to rural segment, the ice cream retailers would like to have smaller deep freezers rather than big ones. So I see this across many categories.
That note, Mr. Tyagarajan, thanks so much for joining in and giving us a view on how things are shaping up for the company. Clearly seems to be betting on a pretty strong summer momentum and looking at how orders will, and right now when it comes to electrification, take 18 to 24 months to finish. On that note, we take a very short break right here on the show. Stay with us. Chartbusters coming right up.